All right, let's dive into one of the hottest and, let's be honest, one of the most dangerous parts of the market right now. 0 days to expiration options. You've probably heard them called 0 DTEs. We're talking about financial instruments that are literally born and die in a single trading day. And their popularity? It's just off the charts.
I mean, how popular are we talking? Well, get this. According to the Chicago Board Options Exchange, the trading volume for 0 DTE options on the S&P 500 has multiplied by 5 in just the last 3 years. This isn't some tiny niche strategy anymore. No, this is a full-blown market phenomenon.
And this quote from Michael Martin, it absolutely nails it. The whole appeal is the shot at a massive return on a tiny bet, and you get the results almost instantly. But, and this is a huge but, just like a lottery ticket, your odds of actually winning are incredibly, incredibly low. It's that high-risk, high-reward tension that we really need to get our heads around.
So before we even start talking about strategies, we have to talk about the risks. Because with 0 DTEs, the risks are cranked up to the absolute extreme. You know, this isn't your slow and steady buy and hold investing. This is like financial Formula One racing, but without the seatbelt if you don't know what you're doing.
I kind of think of these as the 4 horsemen of the 0 DT apocalypse. You've got liquidity risk, where you can't get out of a trade when you want to, and execution risk, where the market's moving so fast you get a terrible price. But the two we really need to zero in on are the big ones, the real monsters. The sudden shock of gamma and the constant, relentless drain of theta. These two forces are what make this game so wild.
So first up is gamma. Just think of gamma as the options accelerator pedal, and on expiration day, that pedal is slammed to the floor. This peak gamma means that even a tiny little wiggle in the S&P 500 can make your options value swing like crazy. A position that's making you money 1 second can be completely worthless the next. It's the force that can make your gains just vanish in the blink of an eye.
And then there's its partner in crime, theta, or as most people call it, time decay. Imagine a ticking clock. Well, on expiration day, that clock is on fire. Every single minute that goes by, the value of your option is literally melting away like an ice cube on hot pavement. If that option isn't in the money by the time the bell rings, its value drops straight to 0. It's a brutal, unstoppable force working against you.
Okay, so with those massive risks staring you in the face, how do people actually trade these things? Well, it pretty much boils down to 2 completely opposite philosophies. You're either the person buying the lottery ticket, or you're the person selling it. And this chart really lays out the whole trade-off perfectly. If you're a buyer, you're betting on a big, fast move in your direction. You need that to beat the clock. Your probability of winning is low, for sure, but your potential reward is huge. Now, if you're a seller, you're taking the other side of that bet. You want the market to do, well, nothing. You have a high probability of winning, but your profit is capped at the small bit of cash you collect up front. And for you, that ticking clock, theta, is your absolute best friend.
But for those sellers, this brings us to one of the most famous warnings in all of trading. You can sit there and have dozens of small, winning trades, just picking up those pennies. But all it takes is one big, unexpected market move, that's the steamroller, to completely flatten you, wiping out all those little wins and a whole lot more. The risk might seem less likely, but when it hits, it can be absolutely catastrophic.
Now, for a quick but really, really critical point on what you're actually trading. See, not all S&P 500 options are the same, and the specific one you pick can save you from a world of hurt. And for this, a lot of experienced traders have a very clear favorite.
This table breaks it down. On one hand, you have options on SPY, the big ETF. The problem is they're physically settled. That means you could wake up and suddenly own or owe 100 shares of the ETF, which is a massive and usually unwanted surprise. Plus, they can be exercised anytime. But then you have SPXW. These are options on the index itself. They are cash settled. No shares, no mess, just a clean cash credit or debit in your account. And they can only be exercised at expiration. It's just a much cleaner, more predictable, and drama-free way to play this high-speed game.
So, this all brings us back to the big question, right? The potential for turning a few $100 into a few thousand in just a couple of hours is obviously a powerful draw. But that thrill comes packaged with the near certainty that your options value is evaporating every second, and the constant risk that your position could blow up in your face. It's a game where the clock is always, always your enemy. And really, the only question left is the thrill worth the price of admission?